Embarking on the retirement journey is a significant milestone, representing the culmination of years of hard work, dedication, and planning. However, this stage of life comes with its own set of challenges and decisions that can significantly impact your financial security and overall well-being. To ensure a smooth transition into retirement and make the most of your golden years, avoiding the common pitfalls many retirees encounter is crucial. In this video, we will explore the biggest retirement mistakes you must avoid at all costs. By understanding and navigating these pitfalls, you'll be better equipped to create a fulfilling, financially stable retirement filled with the experiences you've always dreamed of. So let's delve into these crucial insights and empower ourselves to make informed choices that will shape our retirement years into a time of joy, comfort, and peace of mind. Being too conservative with investments, playing safe might sound like the best approach to your retirement investments, but being overly cautious can hinder your financial growth. While it's crucial to maintain a balanced and diversified investment portfolio, erring too much on caution may lead to your funds not experiencing the potential gains they could. Embracing calculated risks and being open to the possibility of higher returns can play a pivotal role in maximizing your retirement nest egg. History has shown that markets can be volatile and subject to fluctuations. However, a long-term perspective and an appetite for well-researched risks can yield more favorable outcomes. Diversifying your portfolio helps mitigate risks and exposes you to different sectors and industries that could thrive in changing economic climates. It's worth remembering that retirement planning is a marathon, not a sprint. With decades to go before you reach your golden years, you have the advantage of time to ride out market turbulence and capitalize on the power of compounding returns. Engaging with a qualified financial advisor can aid you in crafting an investment strategy that aligns with your risk tolerance, financial goals, and time horizon. Next needs to be more research. Insufficient research was done on the retirement location and plans. The initial assumption was that purchasing low-cost land and setting up facilities would suffice. The idea of residing in a trailer during home construction was also entertained. However, the costs were severely underestimated due to a lack of thorough research. Instead of the anticipated $20,000 or $30,000, the expenses escalated to around $100,000 to bring utilities and zoning up to standards. Additionally, the chosen area had strict regulations prohibiting tiny houses, contrary to assumptions. This experience underscores the significance of comprehensive research before finalizing retirement decisions. The current property was fortunately acquired later, but the initial approach to retirement living suffered from inadequate forethought. This situation taught a valuable lesson about the importance of diligent planning and research, particularly regarding significant life transitions like retirement. Gathering all necessary information and consulting experts is essential to avoid unwelcome surprises and ensure a smoother journey towards one's retirement goals. Ignoring inflation. Inflation, often called the gradual erosion of purchasing power, can significantly impact the value of your retirement savings. As the general price level of goods and services increases, the amount of goods your savings can purchase diminishes. This phenomenon can compound over the years, causing a dent in the adequacy of your retirement funds. For instance, you're planning your retirement based on your living cost. If the inflation rate averages around 2 to 3% per year, which is common, the cost of the same basket of goods and services could double or even triple by the time you retire. This translates to needing substantially more money to maintain the same standard of living in your retirement years. Investing in assets that have historically outpaced inflation, such as stocks or real estate, is prudent to shield your retirement savings from the erosive effects of inflation. These investments have the potential to grow in value over time and provide a buffer against rising prices. Diversifying your investment portfolio can also help mitigate risks associated with inflation. Additionally, periodically revisiting and readjusting your retirement savings strategy is crucial. Reevaluate your financial plan to ensure you're saving enough to counteract the effects of inflation. Consult with financial advisors or use retirement calculators that factor in inflation to understand better the amount you should set aside. Moving on, pursuing individual stocks. If you start investing at age 40, you'll likely waste time and money over the first 3 years. Although there was a shortage of all-encompassing market knowledge, the emerging strategy centered on selecting specific stocks. As a result, they spent between $40,000 and $50,000 on various stocks and other assets. The flawed strategy, fueled by an unrealistic expectation of success, required constant rebalancing of stock holdings. Looking back, we can see that we needed an in-depth understanding of the stock market and investing opportunities. Funds may have been preserved in both time and money had they been invested in retirement target funds. As is now apparent, these funds have been meticulously crafted to help investors of all ages get the most out of their savings by striking the ideal mix between equities and fixed income. The misstep was rooted in excessive self-assurance and an unfounded belief in adeptly navigating the stock market. This unwarranted confidence led to erroneous decisions and financial setbacks. The earnest counsel is to abstain from replicating these errors, seek professional advice, or choose retirement target funds as a wiser alternative. Not saving enough. Starting your retirement savings early is brilliant, but are you putting away enough? Many folks must pay more attention to the funds needed for their dream retirement. Aim to save at least 15% of your income. It might seem hefty now, but your future self will be grateful. Remember, the power of compound interest can work wonders, essentially turning consistent contributions into substantial savings over time. Your well-paved path to retirement bliss begins with setting up contributions to accounts like a 401k or an IRA. These accounts offer tax advantages in a variety of investment options. Don't fret if 15% seems daunting today. You can gradually ramp it up as your income grows. With online retirement calculators, you can personalize your savings goals based on your current financial situation and retirement dreams. Acting now rather than later can make a world of difference. Your dedication to saving now sets the stage for a secure and comfortable retirement. Your future self will thank you for the financial peace of mind you're building today. An upcoming mistake that you must steer clear of is underestimating healthcare costs. Healthcare costs are rising, and underestimating them could be a significant mistake for your retirement plans. As you contemplate your retirement journey, it's crucial to recognize that medical expenses have the potential to erode your hard-earned savings swiftly. To ensure your financial security during retirement, it's essential to gain a realistic understanding of how much you'll need to allocate for healthcare expenses. Consider various factors when forming this estimate. Start with insurance premiums. These regular payments are the foundation of your healthcare coverage and should not be underestimated. Equally important are deductibles, the initial cost you're responsible for before your insurance kicks in. Factoring in these costs ensures you're not caught off guard when medical needs arise. Moreover, think about the possibility of requiring long-term care. The expenses associated with nursing homes, assisted living, or in-home care can be substantial. This aspect gains significance due to the aging population, making it crucial to include potential long-term care expenses in your retirement planning. Please do so to avoid a severe financial gap when you need the most funds. Last but not least, receiving advice from financial experts suggests that accumulating $1 million is a prudent goal for retirement planning. For many individuals, the notion that $1 million is essential for a comfortable retirement has been deeply ingrained. There was a sum of a little over $500,000 not too long ago. In the present time, life is contented in a picturesque location. The scenic backdrop behind serves as proof. However, the discouragement caused by the consistent message asserting the necessity of $1 million for retirement took hold. In hindsight, the current situation demonstrates that living well is achievable without reaching the aforementioned financial milestone. Allowing oneself to be dissuaded by the widespread advice often resulted in less vigilant savings practices around 8, 9, or 10 years ago. Falling into the mindset of questioning the worthiness of the effort due to the assumption of retiring early and laboring at 65 or 70 led to a significant amount of time being squandered. This experience has underscored that the universal rule of requiring $1 million for retirement isn't universally applicable. The financial circumstances, aspirations, and life paths of each individual vary. It is of utmost importance to evaluate what resonates with one's objectives and prevent rigid benchmarks for dictating financial decisions. To sum up, the journey towards retirement is a pivotal chapter in our lives, marking the culmination of years of hard work and preparation. retirement. As we've explored the common pitfalls that retirees often face, we've gained valuable insights that can guide our path to a fulfilling retirement. Thanks for watching. Until next time.